Okay, good morning, everyone, and welcome to the third event we have this week in the Coffee Microcaps Appendix 4C Results Wrap. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time this morning, I'd like to mention our sponsor, Meriwether Capital, who are sponsoring all our virtual events for the next few months. Luke Winchester, who some of you might know, is starting his own microcap fund. So if that's something you might be interested in, please reach out to Luke. Quick compliance and disclaimer. For anybody joining us for the first time, generally the companies we have presenting at these events and indeed our weekly Coffee Microcaps morning meeting, they're under 300 million in market cap, in revenue, and approaching cash flow break even, or indeed already profitable. Generally, we don't have resources or biotech stocks in here, as what I like to call industrial microcaps. So that could be microcap industrial products or services businesses, microcap technology, microcap healthcare. Basically, it's a nice catch-all term for everything outside resources and biotech. Structured this morning's webinar a bit different to normal. We normally would have two companies, actually got four companies presenting over the next 2 hours. Each company is going to have a 30-minute slot, which we'll roughly break down to a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our panelists, please type them in the Q&A box rather than the chat function. Just makes it easier to manage the Q&A when we get there. And please note the webinar is being recorded and it will be on the Coffee Microcaps YouTube channel, not tomorrow, Saturday, but first thing on Monday morning. You can follow Coffee Microcaps Twitter, YouTube for this recording and all our previous recordings if you missed some of the events earlier in the week. LinkedIn, and I also write a weekly paid subscription newsletter, which you can find on the Substack newsletter platform. So first up, we've got a returning guest, Mr. Andreas Kroell from DE.MEM. And then we're going to have another returner, Rod Bishop from Jayride. Indeed, a third returning presenter, Glenn Smith from Tali Digital, will be up then. And Greg Bader and Jan Frere from rent.com.au will be joining us after that. So without further ado, I'm going to hand over to our first presenter this morning. So I'm going to stop sharing my screen. Andreas, do you want to start?
Yeah, you can see my screen, Mark.
I can see it now, and if you just want to go to full screen mode,
yeah,
yes, perfect.
Yeah, all right. Thank you, Mark. Then I just take over from here.
Yes,
so the agenda for today about DE.MEM, my company DE.MEM. So obviously we will focus on recent events and recent announcements. But I would also, for those of you which haven't really heard about DE.MEM yet, would like to kick off with a quick recap of what our company is actually doing. So DE.MEM stands for decentralized membranes. So there is two sides to our business. We operate in the decentralized water and wastewater treatment segments. The solutions that we provide to our customers, they are often containerized, packaged water treatment plants. Decentralized doesn't necessarily mean that we always go into remote locations. We actually work with clients, typically industrial clients, on site at their factory. So for us, decentralized means that we work directly at the water source. This decentralized water treatment market, it's a very fragmented segment of the water treatment industry. There is a lot of small mom and dad type companies operating in that market. It's a market that is consolidating. And it's clearly the vision of DE.MEM to become or to be the market leader internationally in this decentralized water treatment space. Decentralized membranes, the second part to our company that's around the membranes. That's the particular technology which we are deploying, hollow fiber membranes. Because within that context of providing decentralized water treatment solutions, we believe that we need a strong technological competitive edge, a competitive advantage. And that again is in the membranes which are proprietary to our company, manufactured at our manufacturing site at our factory in Singapore. On the next slide, we can visualize a little bit more how our products, how that looks like in practice. So the membranes, hollow fiber membranes, you would see on the upper right of that slide. And how these membranes work, I'll spend a few more words on this in just a minute. We take bundles of these filters, bundle them in these white tubes that you see in the picture on the top center of that slide. We call those white tubes membrane modules. There is about 10 kilometers of fiber in each one of these modules, which make them a very compact filtration device. One of these industrial sized modules is about 8-inch wide and 1 meter and 20 centimeters tall. Just one module can produce about 1 meter cube of water per hour. 1 meter cube, that's about 1,000 liters of water per hour. And then we take these membrane modules as the key component and integrate them into this decentralized containerized water treatment system, which you would find on the top left. And that's then ultimately the turnkey solution that the customer gets from DE.MEM. Plug and play is a very handy format. It's easy to transport. It's in the water treatment industry because customers, they just like that format. That's the introduction. We have now positioned DE.MEM strongly to turn this typically, project-based business model into recurring and stable revenues, into a recurring and stable revenue model. We have a very strong service segment, which includes service, operations, and maintenance contracts, which includes a unique build-on-operate offering under which we lease out these systems. And I'll also spend a few more minutes on the build-on-operate model in particular. But beyond that, we've positioned DE.MEM also so we can really provide this comprehensive range of solutions or one-stop shop of solutions to our strong industrial customer base. We've recently, in April 2021, completed the acquisition of a company called Capic in Perth. This company produces specialty water treatment chemicals that are closely related to membrane plant operations. That includes chemicals like membrane cleaners, antifoulants, anti-scalants, which are used within membrane plant operations or in conjunction with membrane-based water treatment plants. That really allows DE.MEM to offer, pretty much all the important parts of water treatment plants and water treatment plant operations out of one hand. And gives us a very compelling offering and positioning towards our industrial customer base. The acquisition, we've reported about that in detail in the last quarterly, already within just 2 quarters performed extremely well. The motivation behind the acquisition mainly around cross-selling, integrating their product offering into the overall DE.MEM Group offering. We've already seen almost 30% growth on a revenue basis within just two quarters. So we believe this positioning, this strategy, this business offering, it's already paying off. Coming to our membrane technology. So what we are deploying, what we are producing out of our factory in Singapore, it's a technology that's called a hollow fiber membrane. What that looks like, you can see on the picture on the bottom left of this slide. It's a small fiber, a tiny fiber, basically similar to a small straw. It's hollow in the interior, while the walls of that straw are microporous. And then the filtration process works in a way that water molecules are passing through these tiny little pores into the interior of that straw. And all the contaminants that are bigger than the pores, they are rejected, they stay behind. So what we effectively do is that we separate a clean water stream from all types of contaminants. And within that framework, over the years, we've built a comprehensive suite of products, membrane, hollow fiber membrane products. There are three main product families, and how these products work. That's easily explained or best explained on this following slide. So the first and probably commercially most advanced and established product family, that's around our hollow fiber ultrafiltration membrane. That's a technology with pores around the 100 nanometer mark, which aims at removing contaminants such as bacteria, viruses, and small solids. That's well, our proprietary product family number one. Number two would be the hollow fiber nanofiltration membrane, which aims, due to the pore size in the nanometer range, at removing very small molecules, which includes pesticides, herbicides, dyes, which you would find in textile factory wastewater, or certain dissolved molecules such as some salts. So that's what this hollow fiber nanofiltration technology aims at. It can be used partially for desalination in a low energy, in a very energy efficient process. It's pretty interesting technology, as there is basically only one other company worldwide which has a similar technology at the early stages of commercialization. That's a Dutch company which recently listed on the Amsterdam Stock Exchange. So this product family is certainly very unique to DE.MEM. The third product family, that's a new development by our company, and we reported about that in an ASX release dated 7th September. What we are doing here is that we're taking our polymer-based ultrafiltration membranes, and we're enhancing these membranes by simply adding graphene oxide nanoparticles. What sounds like a pretty simple and easy thing, and development is actually based on a lot of work, at least a 2-year process, development process behind in our lab and facility in Singapore. By adding these graphene oxide particles, we're able to improve key characteristics of this membrane, of the polymer membrane, in particular, the water flux, which relates to the throughput or the speed at which the water can pass through the sieve. So what we've observed in well, industrial type trials and projects, as you can see on that picture on the right, what we've observed is that we've been able to increase the water flux by about 20 to 40%, which obviously has a tremendous impact on the operating cost. So that enables us obviously to save a lot of cost for our clients. At the same time, while we're aiming for well, industrial applications, industrial wastewater treatment, recycling applications, at the same time, this increased throughput makes the whole membrane process a lot more compact, because basically we can treat a lot more water with the same amount of membrane, or the same basically space requirement. And that's an aspect that's very important for the domestic water treatment applications as well. So as a little side product, we've already commercialized our membrane technology into domestic under the sink type water filters. For these applications, again, space is a huge constraint, and having a compact technology is extremely important. And that's exactly why we believe that this GO, graphene oxide enhanced membrane, will have great applications for the domestic water treatment as well. And we will certainly update the ASX and our shareholder base over the coming months how this development progresses. This takes us to the business model and how we've positioned the company to our main industrial customer base. So for those of you which have read through the recent quarterlies and the half-year report, you've noted that we've reported about that move towards a service-based business, towards offering build-on-operate type contracts to our customers. That's basically enabled by this one-stop shop offering and by this wide range of capabilities that our customers, our company has built. To be able to offer build-on-operate type of agreements, well, on the one hand, we got the technology. The next one is around the capability to engineer and manufacture integrated water treatment systems. But then also a company which offers that kind of service needs operations capability. So with DE.MEM, we have about 18 qualified water treatment plant operators on site in Australia and Singapore, operating our own, partially our own water treatment facilities. So we got the operations capability as well. And lastly, the company needs to be able to fund leasing type solutions, which is obviously possible through our strong balance sheet with approximately $9 million in cash at this stage. So offering BOO type projects, that's possible because DE.MEM covers all these different aspects and capabilities. And it gives our company a very, very compelling proposition, because industrial customers, they just love this hassle-free service. And on the other hand, in this fragmented market, there are only very, very few companies which can compete in providing these medium-sized, like containerized industrial BOO solutions. So it really gives us a very unique positioning with limited competition. This slide mentions a few examples, reference projects. The one on the right, that relates to the project, one of the two projects which we've announced on 15th September. That's a new 5-year build-on-operate transfer agreement. The customer is a leading market leader in the Australian agricultural industry. Under this BOO or BOOT agreement, we're treating the complete wastewater from the customer's manufacturing site to regulatory standards. So this project is under close supervision of the EPA, the regulator, the environmental authorities. And we're helping the customer here to fulfill their regulatory obligations. This is based on a very long-term 5-year contract, which obviously helps us to build a strong customer relationship with a lot of potential for more work with that same customer. That comes to the next slide on our target customers and our existing customer base. So historically, for those of you which have heard earlier presentations about DE.MEM, our company has been operating in the mining and infrastructure segments. Then about 2 years ago, we've started heavily expanding into the F&B and agricultural sectors. The last BOO contract that I just mentioned gives a good example of how we've accomplished that successful expansion. We've reported in the June quarterly and the half-year report about 2 BOO contracts with a long-term customer from the F&B industry in Singapore, 2 BOO contracts that we've recently commissioned. So the F&B agricultural space, in the meantime, that accounts for about almost 25% of our overall revenues. And then lastly, the other industrial segment, this has become like the fourth pillar, so to speak, of our company. What we're doing there is we're working with customers like AGL, customers that have very stringent requirements, very strict requirements to the water that they need for their, in that case, energy production, energy generation processes. we provide a customer like AGL with ultra pure deionized water, which is based on a membrane process plus additional post-treatment done. So I think that makes it hopefully a bit more visible how we're really fulfilling a high quality service for our customers. We've definitely positioned DE.MEM there in a segment, in a segment of the industry which is high value add. And then when looking into the financials, also a bit more high margin compared to more commoditized water treatment segments. So that takes us to the financials. Before jumping into the financials, I just want to repeat, well, a few key aspects of our strategy. So number one would be the unique technology around our membranes, which come out of Singapore. So the technology obviously gives us a strong competitive edge and something unique that the competitors just don't have access to. Number two is that unique service model through the build on operate offering, the one-stop shop model to industrial customers, which is a very compelling model to the customer base because they get this hassle-free service. And number three is this positioning in a high value add segment of the market with our membrane technology, which is typically deployed for applications such as potable water generation, such as provision of high quality water for industrial processes or recycling reuse type applications. So those are all non-commoditized applications, which are definitely high value add and which require good know-how. So these are key aspects of our strategy, and that's how we have positioned DE.MEM so that we can feed into these type of projects and applications. And I think when looking at the numbers, it's definitely fair to say that we've achieved very solid growth in the recent years and the recent quarter as well, when compared to industry average. So you can look at the growth from different angles. So from a cash receipts angle, we've had 10 consecutive quarters of growth in cash receipts now. On average, accumulated since the beginning of 2020, we've seen about 35% growth in cash receipts versus prior corresponding period. In the peak quarters, it's been up to 70% compared to PCP. And from an accounting perspective, we've seen about 44% in revenue growth in the half-year accounts relative to PCP. So from either direction, we've achieved growth rates which are far above industry average through this positioning of our company. Looking at where this growth is coming from, the growth is obviously driven by our technology and obviously also by our recurring revenue segments, which includes the BOO and the service contracts, but also the provisions of membranes as a replacement item, because membranes are a consumable. The membrane cartridges, modules, they need to be replaced after a certain interval. And the supply of other goods, products that are needed for the water treatment process, such as the specialty chemicals. So the recurring revenue segments, they are really behind this top line growth. In absolute numbers, we've more than tripled the recurring revenues from 2018, about 3.9 million in 2018, calendar year 2018, to more than 12 million on an annualized basis projected for the ongoing calendar year. And in relative terms, we've greatly increased the share of the recurring revenue segments relative to the overall revenues from about 38% in 2018 to 68% in the first 9 months of the ongoing calendar year. So jumping back to the previous slide, so the recurring revenue segments have really been driving growth. And alongside this top line growth and this focus on high value add applications, we've also seen the margins improve tremendously. So the gross margin, which relates to the revenues less all the manufacturing related costs, the gross margin has been growing from about 19% in calendar year 17 to 34% when looking into the P&L for the first 6 months of the ongoing calendar year. And we've definitely positioned the company in a segment that's much higher margin when compared to the P&L that you would see of many of these smaller fragmented family-owned businesses there within our industry. So we're definitely operating well above those comparable companies. The company has seen an EBITDA loss of about 1.1 million in the first 6 months of the year. The cash operating cash flows would fluctuate a little bit beyond that due to the still partially projects based nature of our business, which comes with certain payments that work in either direction. The EBITDA fluctuates on an accounting basis, these working capital movements. This 1 million loss, it basically relates to the reasonable investment that the company is undertaking. On the one hand, into the Singapore side, the R&D, the technology development that has led to, for example, the presentation of that graphene oxide enhanced membrane. But it also relates to the sales and marketing scale up, like the hiring of a few additional salespeople to launch our business in Australia. Coming to the final slide now. So the outlook, what's to be expected of DE.MEM, obviously we believe we're well positioned for further top line growth, driven with a strong focus on our recurring revenue segments. That's clearly the strategy of the board. Post-COVID lockdowns and with the state borders now reopening, we're confident that we will see a lot of new orders coming in. Further build on operate contracts are expected. And acquisition value add certainly part of the story, in a sense that we're now in a post-COVID world will be able to generate further synergies out of these cross-selling opportunities, in particular with respect to the recent acquisition of Capic in Perth. That takes me to the end of my presentation. So any questions, happy to respond now, or obviously anytime through the investor email at DE.MEM.
Thanks, Andreas. I have 2 questions that were emailed in ahead of time for somebody who couldn't join us this morning. The first one was, are you concerned about any supply chain issues? As you just mentioned there, the state borders open up and being able to execute on orders that might have been on hold in recent times.
Yeah, supply chain issues, they are a minor issue, I would say, for us, because we offer a wide variety of products. So we do see that in for certain projects, but at this time, we've always been able to work around that by switching to other components or raw materials.
And then the second question was around that slide on the improving gross margins. The question is, what do you think the gross margin, should settle at in the long term in kind of a steady state?
I think we've already seen a pretty decent development there on the gross margin. It would naturally, with the growing volumes, improve a little bit further. There is a couple of larger companies which are listed on the American Stock Exchange, which are a little bit similar maybe to DE.MEM. There you would find gross margins in the range between 35 and 40%. And taking that as a benchmark, that could be a reasonable comparison mark.
Okay, great. And then one question from the audience quickly. Other cash receipts have been growing significantly. Operating cash flow remains negative. How far away do you think you are from, the kind of inflection point in operating cash flows?
Well, I think this can be answered by simple mathematics, Mark. So the EBITDA was about $1 million negative in the first 6 months. So to achieve that additional gross margin at 34% gross margin would take another 3 million plus in revenues, which takes us for the full year to about 25 million in revenues that would be required for the EBITDA break even.
Okay, great. Andreas, thank you very much for joining us yet again this morning. It was great to get an update. Sorry we got off to a little bit of a rocky start. And yeah, we'll definitely keep an eye out for upcoming announcements now that the state borders are back up and open, and hopefully these projects start coming to fruition that have been on hold for you.
Thank you very much, Mark. Thanks.
If you could please just stop sharing your screen, because I know Rod is waiting patiently for us. And Rod, if you want to start sharing yours. It's just coming through now, Rod. I'll let you know when I can see the cover slide. Yeah, I can see the cover slide of your presentation now, Rod. I think you're still on mute, Rod. Yeah.
Morning, everyone. Thanks for coming. Mark, shall I just crack into it?
Yeah, you can crack into it. I'm just going to knock off video just to make the screen a little bit clearer, if that's okay. Yep, there we go. Perfect.
You're welcome. Okay, good morning, everyone. Thanks for coming. And my name is Rod Bishop. I'm Managing Director and co-founder of Jayride Group. Jayride helps travelers to find and book their rides around the world. We are a travel technology firm at an early stage in a long-term growth trajectory, over 10 years young, but still with a lot of market and a lot of growth ahead of us. As a travel firm, we've obviously been impacted by COVID, but that recovery is well and truly underway now for 6 quarters. Pre-COVID, Jayride grew in terms of growth rates at 98% CAGR for 6 years to December 2019. The onset of COVID, obviously 95% of that business temporarily fled, but 6 strong quarters of growth since. We're well on the way to recovery. And today, I'd like to present to you Jayride's results, a little bit about Jayride as a preamble, then Jayride's latest quarter results, and then talk to you about that travel recovery trade, what we're seeing, the tailwinds to growth, what we expect to see from here. So first, a bit of preamble. Jayride aggregates rides around the world in the same way that, say, Booking.com aggregates hotels. And so this is ride service companies you might know and love, like Lyft, Grab, Careem, Cabify, also local operators that you don't know. For example, a local shuttle bus company that can take you to hotels in Mallorca, Canary Islands, Dominican Republic, Santorini, these sorts of holiday and tourist destinations. Primarily, Jayride is all about those rides. We are global in nature. We serve 95% of world airport travelers go through airports we serve. So that's 1,600 airports. It is next year around about 7 billion trips to and from airports. And we serve them with aggregate supply of over 3,700 fleets. So again, the big fleets and lots of fleets you don't. Always the best local operators wherever you are, be that Vegas or Miami or Sydney. As a technology company, we use technology to our advantage. We have built this aggregation layer on top of the global ride service industry in order to make this marketplace possible. And it's unique in the travel industry. Travel brands like Booking, Expedia, Rome to Rio, Flight Centre, Corporate Travel Management, Car Trawler, whether it's an online travel agency, a travel management company, a meta search agency, big brands or small, they don't have what we have in terms of aggregation of transport. And so we offer to them the entire world of airport rides turnkey through a single API connection. They can plug and play the world of airport transfers. They don't have to build all of our aggregation layer. They can simply sell it to their consumers. So just to finish that little summary, global ride aggregator, travel technology firm at an early stage of a long-term trajectory, impacted by COVID, recovery well underway, and strategic for the large players in the travel industry. So just to give you a bit of a feel when I say global and recovery, there are 3 different tailwinds that are propelling Jayride's growth in recent quarters. And I'd summarize them as follows. 1, it's the end of the COVID cycle, the borders reopening, the return to travel. 2, Jayride's found itself in an improved competitive position relative to other ways that you can source rides, and we're winning market share on the base of that. And 3 is the traveler's behavior, which has changed, and it's led travel brands to lean harder into transfers than ever before. This graph, which shows passenger trips booked, kind of is a nice way to talk about those 3 trends. So first, why passenger trips booked? So this is Jayride's top metric. This is our revenue driver. Every time a passenger trip is booked on the Jayride website, that traveler then goes to travel with a transport company that's listed with us, and Jayride carries the float typically, as we've received the retail fare in advance. If that travel goes successfully, we pay the transport company, we recognize our commission on sale. And so in general, Jayride's revenue is driven by trips. This graph shows trips per quarter for the last 5 years, and it breaks it down by continent. So you can see when I say global in nature, what I mean. Pre-pandemic, we were already a majority share in Northern Hemisphere markets, in particular UK outbound to Europe and North America, domestic and regional around, for example, a leisure traveler from the US to the Caribbean. That business there in Q1 of FY20 was 60,000 trips. And again, already in this quarter, just gone, it is again 60,000 trips. So Jayride has a very good footprint here in those Northern Hemisphere markets. It has recovered to 100% of pre-pandemic PCP. And that's despite, I think, those markets not being back to PCP. Simple kind of market analysis figures to give you a feel for that part of the world. US has the TSA, which publishes that US traveler throughput is only at 75% of prior period. Europe is still lower, circa 60% for UK outbound. IATA.org cites that global, so for example, Australian travel to Europe is still only at 41% of prior period. So despite those market, Jayride is already at 100% of where we used to be. And that's the second piece. That's the evidence that we're winning market share. Thinking ahead to still further reopenings, you can see in dark blue and light blue, Oceania and Asia. Jayride's today only an English language platform. Future long-term potential is obviously to serve this, aggregate rides to travelers in all languages, but at the moment, English language only. So in Oceania and Asia, those destination markets are almost entirely Australian outbound traveler. And so, of course, borders closed. We haven't had Australian outbound travelers in quite a little while. However, count the sleeps, because November 1, right, this is the final business day before November 1's reopening, we'll be able to travel again. We're starting to see, green shoots appearing in those Oceania and Asian destinations, and we're looking forward to a strong recovery in those destination markets for us across the course of the next couple of quarters. Conceptually, where can it go is a really interesting story, and I'd love to unpack for you. Because the third tailwind, I think, is the most interesting for me. And that's about the change to traveler behavior. And if you can imagine, what it was like to be a rides aggregator or a traveler even, who maybe needs some rides in the pre-pandemic landscape, you'd need them occasionally. And if you were, say, a travel brand like Booking.com, your core business is hotels. And Jayride's pitch to you would have been, you can make some interesting ancillary revenue here. You can attach some transfers to your hotels. You can make a few extra dollars of commission. And their response is, well, that's, nice to have, but it's not need to have. Our core business is hotels. Maybe we'll get to it eventually. It was, as I say, it's a vitamin, not a painkiller. In today's landscape, it's a painkiller. Airline revenues are low and depressed. Hotel revenues are low and depressed. Hotel revenues are contingent on travelers feeling confident to travel. So if you're a hotel aggregator, a flight aggregator, any kind of travel brand, your main kind of question right now is how do you convince travelers to travel? And how do you get them back into the skies? And anything that you can do to build traveler confidence has gone into your need to have bucket. Quite besides the revenue implications of that, your core business is now at risk. And so Jayride's proposition in this market is transfers is no longer a nice to have, it's a need to have. You need to be offering door-to-door itineraries to build your travelers' confidence. And so what we're seeing is travel brands step into our segment like never before. And that's the third thing that's driving this recovery, is the uptake in that large-scale B2B partner adoption. Lovely examples of this I could give. A quick one, just in a soundbite. Booking.com, obviously huge hotel aggregator, Jayride partner. They use Jayride's API for rides. Has started all sorts of promotion. For example, right now in certain destinations, they'll give you the transfer for free if you book a certain number of room nights. Now, they've never done a play like that before. And for clarity, they still pay the ride service provider, Jayride, but the amount of money out of their pocket to pay us for the transfer is less than the additional that they make on the additional room nights or the additional conversion rate on their cost of customer acquisition, which is pretty incredible, really, isn't it? Like the idea that those larger brands selling those more mainstream content categories can make more additional revenue through those categories than the cost of the transfer, such that the transfer can be given away for free. We love this. This is a really great example of where we think the traveler behavior is going over the next period. So in summary, in terms of charting that recovery, it's reopenings led, which is of course vaccinations led, but it's also gaining market share, especially in new regions, and it's leveraging hard that new traveler behavior around confidence and what that does to the B2B segments of our industry. What does it look like? It's a modern e-commerce booking experience. So just exactly as you would conceive a hotel or flights aggregator to work, so too does Jayride as a rides aggregator. You can see on the screen search from A to B, a bunch of different options provided across a bunch of different vehicles and service classes, and then a booking confirmation at a fixed price guaranteed. So we take a lot of the pain out, right? Finding rates on tricky things has always been a pain. Having to visit multiple websites or download multiple apps to get price comparison and price discovery has always been a pain. Surge pricing is a pain. We take that away too. You get a fixed price guarantee. It's hard as a traveler to know if you're going to a new market, what ride services are good. If I'm going to, I don't know, Austin for the first time, is Uber or Lyft or Ride Austin or Curb best in Austin? It's hard to know. Jayride solves that problem. We give you reviews you can use so that you know who to travel with ahead of time. We take all the traveler's pain points away. Nothing to download, turn up, get your ride, leave, nothing to uninstall. In terms of the long-term trajectory, we're 10 years young as a startup, but we are early still in growth potential here. Jayride runs, as I've said, rides in 95% of the world's airports, so supply coverage is thick and ready. But in terms of the number of trips that we do, we're just scratching the surface. Pre-pandemic, we were at about 500,000 trips a year run rate. The market is billions of trips. Next year, forecasted to be 7 billion trips to and from airports alone around the world for travelers taking flights. In order to grow, what we need to do is cultivate more channels, cultivate more supply, but just essentially be there for the traveler so that we become the traveler's trusted brand. In terms of how big this thing can feasibly get, just to have you benchmark against other companies in rides in the world. For example, a shuttle bus company in New Zealand, Super Shuttle, does 1 million rides a year. The largest shuttle bus company in the US, also coincidentally called Super Shuttle, does 9 million rides a year. If you think about a global marketplace and how big it can go, bigger than a single ride company can go. And so continuing to grow incremental, step by step, region by region, channel by channel around the world towards our long-term vision, which is to be that door-to-door ride platform that travelers choose to use every time they travel. In terms of where we're at in that product journey, I'd like to just show you the product vision, because this is key to how we win the market over the next period. I've mentioned that we feel like we're in pole position to win market share. Jayride is the largest publicly listed, in fact, the only publicly listed, but the largest aggregator of ride services of this kind for the travel industry in the world. We are the front runner, having come through COVID with a strong balance sheet, finance to continue to pursue our growth ambition. We're competing against small private companies who do rides aggregation. And for the large end of town, Booking, Expedia, the global juggernauts who seek to use our supply, they take confidence in the fact that we're a public company with a strong balance sheet. We're also able then to lean into their requests more and more than any other competing brand, which means that we should be able to entrench our sustainable long-term advantage here just by offering better technology and service offerings than any competing aggregator. So when Booking.com says, for example, we need to do X, Y, Z, we're funded, we have the technology team in-house, we're able to build and deliver that for them. It's cheaper than them doing it themselves. It's better than any competitor can offer. In Q1, that was the release of vehicle types and service classes. This is our expanded offer strategy here on the page. Vehicle types and service classes. Travelers want it. They need specific things in today's environment, whether that's COVID-19 safe, health, security practices, whether that's personal space in extra large vehicles or meet and greets. They don't have to stand in the taxi rank. Travel brands want to sell that. We are now, as of 30th of September, when we launched this platform, able to offer that. We're rolling that out now across all our supply and across all our channel partners this quarter. It's leading to a larger total addressable market through those channels. It's leading to higher average order values on premium products, which translates to higher net revenue, higher margin. It's leading to higher conversion rates where we have, for example, travelers more able to find and book the things they want. It is just the foundation stone. We're going to continue to lean hard into this new traveler offer. Anything that you can conceive you might want as a traveler in your ride service. So be that extras and inclusions like child seats or cancellation and refund policies, non-airport destinations, especially key in Europe, train station terminals, cruise ship terminals, last minute bookings. I'm in Sydney, departure lounge. I'm arriving in Melbourne in an hour and a half. Can I arrange a driver? This sort of, corporate behavior. And then lastly, in destination, from meeting to meeting around town. And to be able to package all of that up and provide it. So for example, Booking.com or Expedia can offer that inside their own ecosystem. That'll be a really meaningful enhancement to their traveler offer and something that's never been done in the travel industry before. So if we move on from here and just look at that financials, we'll talk the latest quarter's result across three things. I'll give you a little deep dive. And then for those who are kind of new to our company, I'll show you the half on half performance as well so that you can see how we've come through. So this is our two top financial measures: net revenue, which is obviously a top line, and then contribution profit, which is our profitability after all variable costs, including advertising, marketing, any variable operating cost like customer service, merchant fees, just anything. We take a very holistic view to what is a variable cost. If it's going to scale with bookings, we call it variable, and we put up for investors this concept of contribution profit, which is our scaling profit after variable costs. In terms of net revenues, that was a growth of 40% quarter over quarter. That's faster than trips. Trips grew 38% quarter over quarter. It's also a growth of over 300% versus Q1 PCP. You can see that growth rate there coming through fast, coming through consistently, 6 quarters deep now into the recovery, but still a lot of recovery potential ahead. In terms of contribution, this is very interesting and it takes people by surprise. Jayride today, despite having lots of recovery ahead, has just posted its second consecutive quarter of all-time highs in terms of contribution profits. This is higher than any previous pre-pandemic high, higher than any prior period, even when we had full volumes. And you can see that there, $187,000 of contribution for the quarter is actually up 189,000 PCP. We were negative contribution in Q1 of last year as we were navigating the pandemic, now robustly positive. And you can see that growth trajectory there again for 6 consecutive quarters. We have so much further opportunity to expand margin, both in terms of travel reopenings, which will drive more volumes, but also, border policies becoming consistent will drive fewer refunds, market share gains as we continue to build the things that Booking, Expedia, and the rest want, continue to enhance our B2C platform, should lead higher conversion rates. That's better return on marketing spend, which means we can spend more on marketing and still maintain high margin. And then lastly, that vehicle services and classes offer that I mentioned with higher average order values, for example. Taking a little bit of a deep dive, just showing you behind the scenes how we think about contribution. Here's an example of how the company breaks down. If you're going to model Jayride, you can model Jayride's entire business on 4 numbers. That is number of trips booked and the growth rate in those trips, the revenues per trip, the contribution margin on those revenues, and then the non-variable cost base that has to exceed. So we're on a standstill operating basis, loss-making at the moment, but not too much growth and recovery ahead until we are profit-making at that standstill operating level and self-funding our own growth from there on out. Ways to think about how contribution margin moves around. Two graphs on the screen just show a little bit of a deep dive in terms of things we're looking at. Left-hand graph shows refund rates. Refund rates, subject of obviously huge impact at the onset of COVID, everyone cancelling their itineraries, but that's been reverting back to norm. Norm for us would be 17% of revenue refund policy for travellers. We kind of stuck there at quarters, but in the most recent quarter down to 24% on the way back to normality. That's one of the things, for example, that drives net revenue per trip growth and drives that to exceed trips growth, because as less refunds come through, we keep more of our revenues per trip go up. You can see on the right-hand graph then impact to contribution. So blue is the actual contribution we posted, and you can see that like very strongly loss-making period there at the onset of COVID. But normalizing for that refund activity, you can see the green line, which shows an ongoing trajectory of improvement as we continue to improve our platform over sequentially 3+ years now. So we're pushing up towards 50% contribution margin. That's our midterm objective, 50% CM on every dollar of revenue. Last quarter, we were at 43x that refund policy. Historically, you can see there we've been pushing up around 50. As refund rates come back to normal, as net revenues continue to increase with that pre-announced that trips and growth, and also the new platform release, that margin is set to expand still further. You can see again there 5 consecutive quarters of recovery through the pandemic. Lastly, just talking about the cash and cash movements, this gives you a feel for how our operating business and our growth focus work together. At the start of the quarter, opening net cash was just a little bit over $1 million, and we had, as you can see there, some inflows, but also some outflows. An operating net loss of 548 is a skinny loss as we navigate still the tail end of this pandemic. We then completed the second tranche of our capital raise. We brought in over the course of the last 2 quarters $11 million of new funding, and then you can see us deploy into growth there, 870,000 for the quarter, leaving us with our strongest balance sheet ever and also now debt-free. And so lastly, just to kind of conclude, this builds upon the previous financial year. You can see here it was a year of 2 halves. Left-hand column gives you 2H. You can see trips growth was 133%, net revenue per trip 8.4%, and contribution margin 141% growth. Those things all multiply each other, as I've said. Trips multiplied by net revenue per trip multiplied by contribution margin. You can see how that growth profile looks geometric. On the right-hand side, then you can see the COVID impact. You can see at that onset for the financial year, we did lose 77% of our revenue. But the thing that takes people by surprise with Jayride is that ongoing focus on margin and optimization of our platform meant that throughout FY20, despite the pandemic, we were actually more profitable. Contribution profits were up to 700% on the previous financial year, and standstill EBITDA up 62%. So despite the revenue loss, that focus on margin has really put us in a great position to rebound and capture the recovery. I noticed the time, and I'd love to take questions. And so just as a quick summary of performance, the FY21 result sets us up with the highest contribution ever, and the Q1 result continues to double down on that, our second consecutive quarter of highest contribution ever above pre-pandemic levels. We are a travel recovery play. In the first instance, we're set to capture more volume as APAC region and Asian regions reopen to Australian travellers, and then continue from there as the recovery trade completes the structural growth potential of travellers' need for transfers, and the fundamental improvements to our platform yielding higher margins, higher net revenues per trip, and just a fundamentally improved offer for the traveller. I would leave it there, Mark, and thank you very much, everyone. Great to be able to tell you about Jayride. I'd love to take questions if anyone in the audience has one.
Cheers. Thanks, Rod. That was great for the update. One of the questions we had a little bit before time is on the slide of the geographic breakdown. They were wanting to know was there anything that caused the US business to go back, given it was like the middle of the US summer? I'm not sure if you can go back to that slide.
I think it's on the screen now, is it, Mark?
Yeah, so the green bar went down in Q1, even though that would incorporate a US summer, and they're kind of well ahead in reopening terms compared to a lot of other places.
Yeah, no, it's a good question. So Q1 is not the full US summer. It incorporates, August and September, which is post the end of summer holidays, then trailing into September. There was a lot of talk at the time of Delta jitters. And I think if you asked every other travel exec, they would tell you that it was Delta jitters and rising case numbers. But when I look at our traffic profile and our destinations, I honestly believe it was Hurricane Ida. And it is refreshing, let me tell you, after 18 months to talk about a weather event as opposed to a viral event having an impact on trips. So Hurricane Ida came through and really beat up the East Coast over the course of the tail end of August and into September. Our core destination markets in the US are those leisure destination markets. I say US, but it is North America. So, for example, Caribbean, for example, Dominican Republic, top destination, Miami, a top destination, including also Orlando and Disneyland, top destination. All of those destinations, leisure travel volume significantly reduced with the bad weather. Another piece of signal for us on that would be that leisure travelers have a bit of discretion about where they travel. If it was Delta jitters, then Vegas wouldn't have increased over the same period. However, that's what we saw. We saw Vegas increase over the same period. So I do actually think it was just the tail end of summer coming through, possibly a bit disrupted by that big hurricane event. In terms of what we expect from seasonality in the US to go forward from here, a little bit of a quiet period at the tail end there of September and into October, but it builds through November into Thanksgiving and then again into holiday season. Same, we should see a good, strong holiday season across Europe. And if we are, following the reopenings, 1st of November in APAC with the reopening of Australian outbound and inbound travel, 8th of November then in the US with the reopening of outbound and inbound, including transatlantic, these are going to be really significant corridors for us. And then when we think about other regions opening up, you've got Fiji on 11th of November, you've got Singapore imminent, you've got Bali imminent. The list really goes on and on. And so looking ahead, really about capturing that reopening trade. One final thought I would just say, our company's strategy is really a total return strategy. I don't ever encourage my team members to get bogged down in this region should do X. We're going to go and find at the moment the lowest hanging fruit wherever there is a juicy reopening travel corridor. And so the team actually performed really well there. Trip volume in Dominican Republic, Miami, etc., started to wane. Supply contracting and partner marketing moved immediately to Europe. And Europe is the top result we've ever had in Europe. And so, more success to them, picking easy wins wherever they're available around the world.
And then a question on the integration. You're talking about, Booking.com and the flight guys all looking now, kind of approaching you and saying, hey, we need to generate ancillary revenue and come to market with an improved offering. Are they plugging it in like right across their system in the markets that you operate? Or are they saying, hey, look, we'll try this in the UK, and if that goes well, we're going to roll it out to the US?
They're all different approaches. So it's tricky to give a single answer for that. But by and large, I'd say at the highest level, we're still scratching the surface on what we believe these brands can do. So, some examples just by categories. If we looked at OTAs, Booking.com has the taxi.booking.com product, which Jayride is a major supplier for. We're one of their top suppliers. And they do contract some supply directly, but we are the largest aggregator that supplies all of their backfill and all of their long tail destinations. When we think about what they can do, and when they think about what they can do, these pilots where they're doing, for example, free transfer attach, if a thing like that were rolled out across their larger set of hotel bookings, just the volume could be really immense. So they are taking still a cautious approach. It's a big company. They move carefully. I won't say slowly, I'll say they move carefully. But where they have rolled this out region by region, it's working very well. The potential of a brand like that, Booking.com pre-pandemic was booking 2 million room nights every day. And so, on 700 million room nights a year, what does an attach rate need to be I mean, it can be a small, and there's still potential millions of trips through a channel like that to win. I'd say the same for Expedia in the OTA space to behave a similar way. In the search engine space, for example, Rome to Rio, we're the major supplier of all door-to-door rides for Rome to Rio. They've got us across all of their channels, but it's just one of many ride categories for them. And so it's more about making sure that door-to-door rides get more exposure than, for example, rail or public bus or train. For Flight Centre and Corporate Travel Management and the other major TMCs, it tends to be a regional rollout based on the origin of the traveller. So, for example, pre-pandemic, great relationship with Flight Centre's corporate brands in Australia, but not so much of a relationship with their corporate brands in the US, for example. So, just stepping it out region by region and capturing the volume around the world.
And then one final one, I will just squeeze it in quickly on the revenue per trip. Given you're one of the last men standing, as we get further into this recovery, do you think you're going to have more pricing power in the market, let's say a year, 18 months out from now?
More pricing power, more buying power too. Transport companies want volume, and with volume, they give discounts. And so as an example, an immediate thing we're working on is Europe. I want to be more impressed by our TTV per trip and our revenue per trip in Europe than I currently am, but we're delivering volume to these transport companies in Europe for the very first time. And so we get the opportunity to now call them back and say, we can take your volume still further. We just need better rates. So that, and also the bringing to market in an aggregate form of all of that category, pricing and buying power, are up for grabs. And yes, we can do more. Just if I've got the time, I'll give a 1-minute explainer of this slide on the screen. For those who are modeling Jayride for the first time, this is how to do it. Passenger trips booked times net revenue per trip times contribution margin, less your non-variable operating and corporate costs. You can see halves of track record there. You can see in passenger trips booked the little bit of the depression through COVID. You can see net revenue per trip similarly depressed through COVID due to primarily higher refund rates than normal. But you can see contribution margin here with the fundamental improvements we've made progressing towards 50%, and non-variable operating and corporate costs reasonably stable throughout. If you were to quickly want to model Jayride to that cash generative position where we're self-funding our own growth investments, this is how you do it. And a very quick line of sight for you on that would be 220,000 trips and a half. So that's equal to pre-pandemic volumes, $10 net revenue per trip. So that's using that pricing and buying power, but it's also just getting us back to where we were pre-pandemic, X those refunds. 50% contribution margin due to all the fundamental improvements. That would yield $1.1 million of contribution, which would fund all of the non-variable operating costs of the company. So you can see very clearly that scale in trips and return to normal unit economics gets us there. And it's just about chasing that recovery.
Great, Rod. We're going to leave it there because I do know Glenn has been waiting patiently for us. And thank you for that update. And yeah, I'm sure everybody looking forward to 1 November and hopefully further relaxation and travel right across the globe.
Absolutely. Thanks, Mark, for hosting. I really appreciate it. Good to see you.
Okay, and Glenn, if you want to start sharing your screen, we'll jump straight into it. Thank you very much for your patience.
Okay, thank you, Mark. Hello, everyone. Just bear with me. I'll share the screen.
It's coming through now. Yeah, I can see the cover slide of your presentation now and in full screen. Perfect.
Excellent. Well, thank you, Mark, and thank you everyone for your time. My name is Glenn Smith. I'm Managing Director of Tali Digital. We're pioneering digital therapeutics. And I'll break that down a little bit in this particular presentation along with our last quarter. But what we're doing is we're really delivering software as a medical treatment. Our code is TD1 for reference. So what were our quarterly highlights? What we're really trying to do now is begin to drive revenue and then drive towards profitability. And some of the key highlights for the July-September quarter were around our strategic licensing agreement with a venture in the US called Achille Interactive. Now, they're a very large venture in the digital therapeutic space in North America. They have FDA clearance for their digital therapeutics. And that is very complementary to what we do because they service a later stage age group than we do. and we service children between the ages of 3 to 8. And I'll tell you why that's important in a moment. But from a revenue and then profitability perspective, that particular license agreement will deliver an expected $51 million in milestone payments, and then ongoing royalties every time a child uses our test or treatment in America. So it's a real key strategic agreement for us, and I'll break that down in a little bit. We're certainly beefing up our leadership group in Tali. We're recruiting significant people from chief marketing officers to different product people to significant beefing up of our business development and sales area. Our chief marketing officer is actually the ex-head of Australia, New Zealand and Asia Pac for ResMed. And she comes to us with a significant ability to roll out products both at a wholesale and retail level. And by that, I mean wholesale directly into the healthcare market, and then retail direct to consumer, which is the two areas that we'll focus on with Tali. We've also received a $500,000 non-dilutive R&D facility from the Victorian government, and we'll deploy that money directly straight into our partnership with Achille, because every time we ship more product to them and deliver on our development and clinical and regulatory milestones with them, we get paid. So we'll put that cash to work because it generates revenue for us. We had a low operating net cash flow outflow during the first quarter of $500,000. And we're just optimizing the business towards more of a marketing and sales led business rather than an R&D and development business. Closing cash balance of 2.2 plus the $500,000 R&D facility on top of that certainly sets us up for 4 quarters of cash and allows us to start to generate revenue and improve our cash position over the forward period. So we can achieve our commercialization milestones without a capital raise. And we have a partnership in India, which I'll break down for you as well, with the Times Group in India. And our advertising and marketing launch really ramps up this quarter. And we're looking to generate sales and customer acquisition activities in India at the end of this quarter and really through 2022. So some significant developments in the last quarter really setting us up for that growth and revenue profile. So what have we achieved and where we're going? And so what's the backbone of Tali and why it's important? The image you see on your screen is how we deliver our products. They're gamified software solutions delivered as applications to children to help treat attention and attention-related disorders. So they're very intuitive and non-threatening for the end user, and that is the child, but they're very sophisticated for the carer, healthcare professional, and educator who's delivering these programs with the child. So we have significant patents granted in US, Japan, Australia, EU, New Zealand, Canada, significant trademark portfolio. And what everyone needs to recognize about Tali is that we are the same as any other biotech, medtech, pharma company on the planet. We support all our programs with underlying clinical research programs. So randomized controlled trials, we publish the data, they're peer-reviewed publications. We're backed by over 20 years of research. And we actually go through regulatory processes for our software. So we're regulated medical devices in Australia, in the US with the FDA, and in Europe with the CE mark. We have a partnership strategy along with a direct sales strategy in certain markets. The partnership strategy really is to look at those big, significant markets like the US, partner with those companies who have significant marketing and sales assets and resources in the field to help us roll out the technology. And we've done that with Achille. We partner with the most preeminent research and clinical institutions on the planet. And one of those is Duke University in the US. Same in Singapore with our clinical partnerships. These really drive the brand awareness, recognition, and trust of our programs in market. And we have the Times Group in India, that largest media player in that subcontinent area, helping us access that middle class in India and really driving the uptake and sales of our products. As I said, we're revenue ready and have set up those partnerships, particularly with India in the brand capital Times Group family, and also with Achille in the US. So what does that mean from a strategy and a commercialization perspective? And I guess this is how you as an investor can really track us and then rate our performance. Currently, the opportunity really is in attention screening and training. So we have delivered our Tali product, which is made up of 2 modules, the detection, so a 20-minute test, and then the training treatment program, which runs over multiple weeks and months. So we're in market and we're launching those activities now. And we're really focusing on channels such as the consumer, early childhood care and education, and healthcare through a B2B to C model. So really looking at those allied health professionals who already own the patient, so the child and the parent, and them delivering it out directly to those consumers. Our core targets are Australia, New Zealand, Singapore, and India. And then we have those partnerships, particularly with Achilles, where we're looking at specific disease indications, such as attention deficit hyperactivity disorder and autism spectrum disorder. And so we're working through a clinical development and regulatory strategy with Achilles, and we're looking to get that approval in 2023 and really drive a large-scale marketing and sales activity to obtain a footprint, a really early footprint, where we're the pioneers in that area. And why that's important, because we can have labels that generate higher reimbursement options. So think about drugs that are delivered to ADHD children or ASD children. On the labels, they say, take this particular drug over a 3-month period if you have ADHD, and we'll continue the prescription from that point on. So there are higher reimbursement delivery options, and we'll label our product to be actual therapies for ADHD so that we can access payer and insurance payments in the US. That generates higher margins. It also delivers optimal patient care. So we have an ongoing annuity model there, an ongoing higher patient care model, which will deliver more patients and more revenue to us. And our blue sky really is around new clinical indications on our platform technology. Our technology is a platform technology, so we layer over the top of the platform these particular programs and applications. And we know that in this area of neuroscience and neuroplasticity and cognitive function and decline, we can test our products in those cognitive decline areas. We're about to embark on that research program in 2022, really looking at this whole area of mild cognitive impairment, so that decline phase that leads to early onset dementias and then Alzheimer, and really looking to see if we can test and improve the treatment and quality of life in that area. So it's a really big blue sky opportunity for us, but one that really demonstrates that this company is going to be a multi-year, multi-generational company, such as some of the other big healthcare companies from Australia that have come before. So what does the Achilles partnership really look like in a milestone delivery for you as an investor? We're in that clinical development phase now, and we've commenced that in this current quarter. We expect payments from that clinical development to start to be invoiced and delivered in the next quarter, so that January to March period in 2022. That leads us into an FDA submission around Q1 or Q2 of the next financial year, so FY 2023. And that delivers milestone payments once we submit and get approval. So the contract delivers significant multi-million-dollar milestone payments at that particular point in time. And once we deliver that FDA approval, we actually hand over the product to Achilles and their 200+ strong marketing and sales force to actually put into market and start to generate revenue. Every time they do that and hit a sales target, we get multi-million-dollar milestone payments plus a royalty per child. So that's really a significant input in our ongoing annuity revenue model. So this whole theory and strategy around having key partners in key markets that set up the foundational revenue and ongoing annuity model for us is key to our longevity. The same principle really applies with the Times Group, except we own the actual delivery of the model in India. So we own 100% of the revenue generation. They deliver us marketing and advertising assets and access to the middle-class consumer in the Indian market, because they own that middle-class consumer through their media assets. So we're commencing the formal launch of that advertising campaign this quarter. We'll spend approximately $2 million over the forward periods, generating that brand awareness recognition building a strong lead pipeline, and converting those people into our Tali paid subscription model. During the next quarters of this financial year, we'll expand those campaigns and really looking to drive the grower subscription model and drive revenue there. And then in the last quarter of this financial year, we're really looking at a wider government strategy where we're looking at tenders and other type of partnership opportunities with government in India, where we can deploy Tali into the education sector in India, which is surprisingly well-funded, sophisticated, and a real key driver for the Indian parent in relation to how they deliver tools to improve their child's performance so they have a better education outcome. So it's a really exciting emerging economy. It is the world's largest and fastest growing mobile and smartphone economy. Our products are purely suited to that touchscreen smartphone device. And they're also very suited to the Indian parent who wants to improve the cognitive function and performance of their child to deliver better education outcomes. I think it's important just to quickly show you some of the evidence and remind people that everything we do is based on evidence. So when we market, we are evidence-led company that can demonstrate the provenness of our technology. And then we overlay on top of that consumer marketing strategies to help get people across what we're trying to do. But our Tali Detect program, the first test, is validated. So it's benchmarked against existing technologies in the market. And in this study, it's showing that it's either achieved the same status or indeed exceeded the current technology in the market to detect probable attention deficits in children. And that can be done in only 20 minutes through our gamified program. So it's a really significant achievement in this area because a lot of the testing done on children at the moment is either through rudimentary written technology or old technology, or either in clinic, which takes up a whole lot more time and is really not an optimal way to test a child. And the beauty of our gamified programs is children don't know they're being tested. So think about Tali Detect like you would a blood test. You get a blood test, it's really quick, but the data that comes back from it is really critical to saying to you and everyone around you, what are the next steps of intervention and what type of diseases are you likely to have from that blood work? And you take action immediately. The same type of report comes from Tali Detect. What type of attention or cognitive function issues is that child usually having a probability to have? And what action should a parent or a healthcare professional or teacher take? And that immediate action can be our Tali Train product, which is here showing that it has proven gains, not only in selection, but actual accuracy in terms of selection. It also is proven to deliver numeracy benefits to children. So combine that focus and control in selection and accuracy with those numeracy benefits, and you really have a holistic program that can be delivered to a child in an education and healthcare setting where you can deliver immediate benefits in combination with other things that you may do with that child, which sets them up for success. It delivers them a new cognitive function foundation. And that's really important because early on in life, that's when neuroplasticity is at its peak. It's when the brain is really forming those neural connections and pathways, and you can make a physiological difference to that child, even through these gamified applications. And that's why Tali works. We've got a proven leadership in healthcare and technology in Tali. We're going to build up that leadership in the executive committee and also at the board level as we build our marketing and revenue strategy. But the core of our directorship is really key to driving this particular marketing and revenue strategy forward. And so what should you focus on in 2022, FY23? Sorry, that should be FY 2022 and 23. That's a typo there. But the key points really are, we're focused on that delivery of revenue and growth. So growth in customer acquisition, delivering revenue either in a paid subscription model or through our direct to healthcare model or through our partnership model with Achille. We're going to allocate more resources to expand into Asia. That's a real emerging opportunity in terms of technology use, so touchscreen smartphone use, along with parents and other type of educators and healthcare professionals becoming very cognizant about early childhood intervention and cognitive function and performance and what tools you use to assist that. We're going to drive those regulatory and reimbursement strategies with our partner and drive new solutions in markets to deliver those milestone payments. The global opportunities really are around partnerships in Asia and emerging markets. We want to deliver more corporate partnerships through healthcare and delivery reimbursement models in the UK, Europe, and Canada. The UK, interestingly enough, is the world's oldest and largest insurance scheme. And we think there are a lot of like for like between Australia, particularly our National Disability Insurance Scheme in the UK, National Health Service, and how we can insert our products into the UK. So we'll be pushing a lot further into the UK in 2023 and really looking at those R&D partnerships and clinical work we'll do for this mild cognitive impairment study. So we're really not only setting ourselves up to deliver customer acquisition and revenue through the remainder of this financial year and in calendar 2022, but really setting ourselves up for multi-year and multi-decade success through the delivery of new product developments and then the blue sky opportunities in later stage life and cognitive decline areas. So again, I thank you for your time. I welcome questions and contact from you post this session. But Tali, currently we're focused on creating happier kids and we look forward to generating revenues as we move forward. Back to you, Mark.
Thanks, Glenn. I might just kick off the questions. In terms of deals of a similar size as the Akali Interactive, do you think that's possible in, say, Japan or Europe, or, have you kind of landed the big fish, kind of with the first cast?
Yeah, it's a good question. I mean, part of why we executed this agreement with Akili was twofold. Obviously, it delivers us a really good channel to market in the US and really significant expected revenues and an annuity model there. But it does two other things for us. It validates our technology. Akili is a well-backed company with pharma companies on their share register, along with other large technology ventures and VCs out of Silicon Valley. So there was a significant amount of DD there. So it validates the Tali technology platform. And remembering Akili are licensing our technology and we're building the technology applications for them. So they're actually using our technology platform and our applications will be marketed and sold by them. So it's significantly telling the market, or should tell the market, that our technology platform is really superior in this area to anything that they could come up with. The second thing is it gives us the ability to replicate that model in other large sophisticated markets like Japan, Korea, the UK, Canada. So we can actually replicate these licensing models elsewhere. And in fact, that is a key strategic business development activity for us internally. And we've been doing a lot of work, even during this COVID period where we haven't been able to reach face-to-face with particular Asian markets where that's important, but we've been in significant confidential discussions with major parties overseas. And I think the replication of that model will show itself in 2022. So yeah, we're very excited about the model that we have and where we can go with it.
And then in terms of the customer education piece, I think we talked about on your last one, but might be good to just refresh the teachers in terms of, highlighting stuff to parents. What strategy are you putting in place, to really, once you have like in India, what's going to come in the US and these other markets, to say, hey, look, if you've got kids who may be in need of an assessment in the first instance, how are they going to think of Tali, top of mind, I guess?
Yeah, it's really a twofold strategy. So when you think about healthcare professionals or educators as examples, we're really partnering with the overarching governing bodies and associations that relevant healthcare professionals and teachers are members of, and we're putting together education packs and information in digital form, which they can use in classrooms or their healthcare practices, so they can deliver out to parents and start to inform parents about these new tools and deliver them in the education classes. We're also partnering with universities and other type of institutions in Australia and overseas where we're getting early, so we're partnering with universities to teach the next generation of teachers about these tools and using Tali in their actual education programs. So they're university degrees. So when they leave those university degrees, they're taking the Tali tool with them on their first day into the classrooms and telling the schools that these are the type of tools they want to use in the classroom setting and educate parents about. So that's the strategy there. With parents, it really is a traditional digital influencer strategy. So we're really partnering with key opinion leaders and influencers through digital and social formats, and key disease associations in ADHD, autism spectrum disorder, and other behavioural issues, where we influence the parent and drive them towards Tali or other type of education points or member-based organisations where they have a lot of information about Tali, and really that disseminates into a wider word-of-mouth strategy for us. So I think, from an investor perspective, you'll see a lot more of that activity as we move through the rest of this financial year and the remainder of calendar year 2022.
And then one from the audience. Do you think it could be possible in time that Tali Digital could be used as part of a national, children's screening healthcare program? As we see, there's lots of programs within, state schools where they're, doing screening at various different points in time for, kind of general medical issues. Do you think with the kind of surge in mental health awareness that some governments might start looking at utilizing Tali as a screening thing on a kind of national public health basis?
Yeah, and we've certainly been planning that in the background. We've had a government relations strategy in place for a little while. And just briefly, the simple answer to the question is yes. So we think Tali or attention screening or attention deficits are akin to doing the same type of screening in the hearing or the dental space. So those national dental and hearing programs that are rolled out. So that is the plan and the vision for what we want to achieve in Tali and other first world countries in the education sector. We're looking at a multi-pronged approach there. So we're working with state governments, but also the federal government. We've actually got a pilot program in Queensland at the moment in a large Indigenous population, where we're working with federal ministers who actually went out to a place called Woorabinda only a couple of weeks ago. Unfortunately, we couldn't go because of COVID, but they were out there seeing Tali in action in the Indigenous population. So that type of strategy where we focus in on those most at need, have governments fund those programs, and then we build out that case for wider populations is part of our strategy. So I think we really have planned for that. We really think that's a possibility. And the simple answer is yes, Tali and programs that really look at attention disorders and mental wellbeing should be nationally funded, just like dental and hearing programs.
Glenn, I think we'll leave it there. We've caught up a little bit of time, so thank you for helping us out there. And please get in touch with Glenn if anyone's got any further questions at info@talihealth.com. And we look forward to these milestone payments and deliverables getting checked off the list over the next 12 months.
Great. Thanks, Mark. Appreciate the time.
Cheers. Thanks, Glenn. And I do know we have Greg and Jan standing by for our last set of presenters today. So we'll just get them to share their screen. It's coming through now. And if you could just go to slide share mode, just so we get the full screen effect, please. Yep, there we go. Perfect.
Are we good to go, Mark?
You're good to go, Greg. Yep, whenever you are.
Well, good morning, everybody. Greg Bader. I'm the CEO. I've got Jan Ferreira here, who's our COO. We're going to tag team a little bit, but also just go through our results and then just explain a little bit about what we're doing and who we are. So I guess, as our name indicates, we look after the renting market. And I guess there's a couple of things we need to just be clear on this. The renters that we think of 20 years ago is completely different to today. So the fastest growing segment are what we call our logical or lifestyle renters. They're typically professional, millennial, living in the major cities. This generation is our best educated, financially savvy, they travel. So they're in a phase of their life where they're building their careers or relationships, and they value the lifestyle and flexibility that renting offers. They're at a point in their life where they're just not comfortable to put down a massive mortgage in Sydney, for example. They're not sure of what it's going to cost them in terms of other aspects of their life. Interesting though, we have about 24% of this group either own a property or are saving to buy a property they don't intend to live in. So that's what we call our rent investors. So we really have, I guess, two parts to our business. Our existing business, rent.com.au, is our portal. We focused on renters and we deliver products that get them into, get them into their home. We invented our renter resume, now well over 1 million users. We add a lot of additional features like walkability, NBN, lifestyle and whatnot. So we try and make our portal a lot different to others in the market, and it's really is focused on adding value to the consumer. We have finance tools in there, etc., to help making that process a little bit easier. Great business, 700,000 unique visitors a month. The challenge we have with it, or the opportunity we see here, is that the typical person looks for a property for 4 to 6 weeks, and then they're in a tenancy for 30 months. So RentPay is our new product, and the purpose of RentPay is to maintain that relationship with a customer throughout their tenancy period. It gives us an opportunity to add value to them, and I guess build on that relationship, offer new products and services, and really the key function of RentPay is to reverse that stigma around rent money is dead money. We want to add value to someone throughout their tenancy period. I guess just quickly capping off our results, best ever FY, and last quarter was our best ever quarter. And more importantly, strong growth across all our metrics. We're really proud of some of our results. The #1 real estate app in both app stores, strong traffic, and a key part of that traffic, it's over the last few years, we've really worked hard to make that organic traffic, so we're not buying that traffic. And as I mentioned earlier, 1.18 million renter resumes. We're adding about 20,000 a month of those, and that's our online application process to help people get into a house. And we're doing over 100,000 inquiries and applications on properties throughout Australia in any given month. I might just hand over to Jan, cover off our quarterly in a little bit more detail.
Thanks, Greg. Specifically on the portal business, we've worked really hard to make this a profitable business, and it's really pleasing for us that over the last 5 quarters, we've consistently managed that. Last quarter, as Greg mentioned, being the best one we've achieved. So profits growing, but we've got more profits coming down the line from new products and expanding our audience. Looking forward, December quarter is normally a little bit slower because not a lot of people move then, but we've got some good signs indicating that the January to March quarter is going to be very strong, especially with interstate mobility improving and potentially the return of overseas students and migrants early next year. In terms of the products, so roughly 50% of our portal revenue comes from products, and the other 50% comes from advertising. So in the last quarter, this was a little bit affected by the Sydney and Melbourne lockdowns, almost half the population being in lockdown. But what's been really pleasing for us is that our share of our partners' revenue has improved. So for example, the Rent Connect product, which is a partnership with AGL, that helps people connect electricity and gas accounts. We are now consistently delivering well over 10% of AGL's net national new connections. Rent Bond, which is a fantastic product which sort of bridges that gap between you having to put down your bond on the new place and recovering the bond from the old place. We've structured that so that within 3 weeks, if you pay it back within those 21 days, it costs you absolutely nothing. We're now seeing that rent bond is one of the largest bond finances in the country. We're really growing that share beautifully. Rent check for us is a bit of a leading indicator because that comes right at the start of the sort of the whole moving process when people are preparing the application, starting to look for new properties. The penetration of that product has also increased a lot, and absolute volumes have increased, which really bode well for that March quarter. From an advertising perspective, we do have a lot to offer advertisers. We focus on delivering the right ads. We work with advertisers on renter-friendly messaging, and through that, we've been able to lock in long-term contracts with very key blue-chip advertisers. This helps us work with them to deliver better return on their ad spend and a real sort of personal focus on making sure that it works for them. The nature of renting means that 4 to 6 week window where people are searching means that 70% of our audience is new every month. So advertisers have the confidence that they're not wasting their money by marketing the same stuff to the same people every month. So that's helped us build that. We've got a really solid sales pipeline. Over 60% of our FY21 revenue has already been contracted for FY22. So that gives us a fantastic foundation for growth. To really sort of pursue that growth, we are going to be looking at expanding the resourcing in advertising over the next 6 months.
Good. Thanks, Jan. As I previously mentioned, we see the opportunity to extend our relationship with the customer from 6 weeks into the tenancy period, build a permanent relation, add value throughout their tenancy period. So this is what RentPay is about. So this is the essence, I guess, of RentPay. We provide flexibility and choice to the renter, but consistency and certainty to the agent. So it's really, we're sitting in the middle here and providing value both ways. On top of that, recognition and reward consistently poll as some of the strongest drivers or needs, if you like, for our renters. So what we're looking to do here is make your rent money work for you and reverse that whole rent money is dead money story. So we're the first in market, and we have a model here where your regular rental payments can grow your credit score. So think about that. No one else in Australia is doing that. It's recently rolled out in the UK. But our plan here is you rent for a few years, and if you transition to a mortgage or you transition to another loan product, your time renting has contributed to improving your financial standing, gives you more choices as you enter that market. That's a huge thing. For agents, we're already seeing that some of the features that RentPay offers, we've got our buffer. So we had over 40% of our customers asking for this, basically wanting to save a little bit and get ahead of a future rent payment. You think about COVID, casualisation of the workforce, they're all drivers for that. We have Safety Net, which is a buy now, pay later emergency funding opportunity. If your car blows up on Wednesday and your rent's due on Friday, we'll loan you the rent money. And then obviously the Score Builder. So all of these products together, we're seeing our default rates for tenants paying rent is less for customers using RentPay than the general market. So that's a big win for real estate agents. Look, it's a massive market. You know, 2 key drivers here are growth of customer numbers and then ARPU. If you think about it, we've got, you know, over 2 million renters in the market, each paying rent each month. So our challenge or our focus, if you like, is growing our share of this market. And, you know, you can see the numbers on the screen there. It compounds quite nicely. Another key part of this for us is that our portal business, because we focus on people moving, it's basically spot sales. So the beauty of RentPay for us is it builds us that annuity stream as well, where it compounds each month. So we're in the market now. We've been in the wild for a couple of months. We had some early challenges. I guess onboarding a customer, there is AML, KYC, there's a lot of regulatory checks we need to do. So getting the balance between a smooth, simple process and whilst meeting all our requirements in that area has been a challenge. And I don't think we've got it perfect yet. It's a lot better than it was, but we'll still keep on working through that as we go. It's an area of continuous improvement. We've also got technology changes coming down the pipeline. Unfortunately, RentPay is probably a little early in market, and the broader banking and finance rails in Australia aren't quite there yet. You know, things like scheduled instant payments in, etc. So obviously we use what we can, instant payments out, etc. But there will be technology changes on how money is moved in Australia that will roll out over the next 12 to 18 months. And then obviously we'll be adding new payment options as well, whether that's crypto or Alipay, etc. Marketing activities underway in a limited fashion. As I mentioned, this is a new segment as much as it is a new product. So education, I guess, goes hand in hand with awareness. We're starting to see the results of these, especially around our organic and our direct traffic. So this is people finding us via search, etc. So as a small cap, and we learned this lesson through our portal business, you can't spend your way to growth. We're up against a couple of gorillas in that space, so we need to be smarter. So there's a lot of effort around content creation, social, etc. That said, we are planning for a major marketing campaign next half. So a lot of this work we're doing now is, I guess I consider as groundwork. It's making our future spend as efficient as possible. And agent chats are progressing. We've hopefully got some news coming out over the next few weeks, but you know, by us building a product that faces the consumer, and this is the essence of RentPay, it talks to the consumer. We expect consumers to sign up to RentPay. We are transparent to the real estate agent, but if a real estate agent comes on board, there are a bunch of benefits to them, not only in the lower default rates, etc., but we have advantages around reconciliation, cost, etc. So basically it saves an agency time and money. This has always been a key part for us, that we see, I guess, RentPay as an ecosystem where partners can come in and add value. There's a lot of chats underway at the moment, and I guess I've highlighted a couple of areas we think are pretty interesting. Just picking on a simple example, I guess, is utilities. So at the moment, most people consume electricity or gas in Australia. They consume for 3 months and then they've got 30 days to pay. So you've got 4 months of accrued consumption out there before the retailer gets any cash back. So if we simply move people paying their utility bills to the same time as they pay their rent, and we've got 40% of customers are asking to do this, then at scale, at 10% market share, we're talking a $50 million a month cash flow improvement to a utility and a corresponding improvement in bad debt. Obviously, everybody's paying smaller amounts more regularly. So there's some of the opportunities. The mortgage one's really exciting as well. Our Score Builder product is all around building a person's, I guess, credibility, wealth, standing, through their time of renting, using their rent to leverage that. So we see there's a real opportunity here for mortgages as well. Now, not every renter will move to a mortgage, but certainly a large bunch will. So partnering with a provider in this space and giving the customer some advantage as they go through their renting journey, we think that's pretty interesting. And we think it has quite a significant competitive element in the world of mortgages as well. So I guess just to summarize, and more than happy to take questions, we've had a cracker of an FY. Last quarter was strong. As Jan mentioned, next quarter we typically, and when I say typically, every year, we see a general softening. It's no surprise. People want to take holidays. Be interesting to see how New South Wales, Victoria, our two biggest markets, borders, restrictions opening up, how that impacts. We possibly will have a bit of a bigger dip, but we tend to wind down over the second week in December anyway. But all things are pointing to a cracker of a January, February, March and onwards. So that's going to be pretty exciting. We're continuing to invest in RentPay. There's continuing to develop. We've got a product roadmap coming through that's pretty exciting. We're expecting growth across both. We're winding up our marketing activity, as I said, ready for a bigger push next year. And this increased profile of our business is helping us with conversations with potential partners as well. And on top of that, there's a lot of interesting tech in the market. There's M&A opportunities, whether that's us partnering with someone or rather than building a piece of tech, acquiring it, we're looking at those opportunities. So yeah, we're really excited where we're going, and yeah, happy to take a couple of questions. Back to you, Mark.
Yeah, cheers, Greg. Thanks, Jan. I might kick off one or two. The ramp up in advertising, is that coming from, you know, with lockdowns easing and stuff, is that coming from existing partners you have, you know, really starting to ramp up their spend, or is it you guys actually bringing new advertising partners into the mix?
So it's a bit of everything. So obviously we have a big high traffic portal that we will talk to. The interesting thing is rent.com.au, our portal, is talking to 5% of the market at any point in time. That's the people that are actively searching. So rent pay is available to 100% of the market. So we're also looking at opportunities to talk to the 95% that aren't moving. Now, given our customer base, it lends itself to a lot of online type advertising. So we have been doing a fair bit in social media. We've got a whole content creation program going on at the moment, with videos and customer stories, etc. So all that groundwork, I guess, is being laid at the moment. And then early next year, we'll look to expand on that. We're trying a lot of things, and we will obviously filter that list down to the stuff that delivers best bang for buck. But certainly working with partners is part of that as well. And you will see more of that into the new year.
And then just on the rent pay, it might be instructive just to go back to the little pro forma table that you had there. And I think the ARPU increases, in your model from $6 to $12, I think it was. What drives that, 6 to 12 as you ramp up in customers? Is it more pricing power, or why does it scale the same as the customer scale?
Yeah, so look, they're just indicative, but we do see growing ARPU as a major part of this. So just back on our utilities model as well, if we've got customers that are prepared to pay their bills more frequently, then that's a huge advantage to the retailer. We would expect that retailer to pass through some of that discounting or advantage back to not only our customers, but to ourselves as well. So that's one example of the ARPU increasing.
Okay, great, thanks. Another question: how many more additional products do you think you can build into the portal business? You were talking, about insurance and moving, and the partnership with AGL. Is there anything else you're thinking of that can be part and parcel of the portal business?
Yeah, there is. There's a bunch of stuff in the pipeline. I guess one of the things we should probably point out is we're not we don't see ourselves as a comparison type site. We're not an iSelect or a compare the market. We work hard. Our whole business is around customer relationship. We're the only real estate portal that actually talks to customers. So our preference is to partner with a single entity in different verticals. Now, AGL is a good example because that's our partner on our utility side. You won't see any other utilities advertised on our site. The theory of that is that by working with a single partner, we can maximize the value all round. So with the AGL example, we've now got a product that's the best in market. We've got a product that has lowered AGL's acquisition costs substantially for them, and we've got a product that brings revenue back to rent. So it's actually it's an all-round win for everybody, and we expect to take that into other verticals. In telecommunications, we partner with Optus. We're not to the discussions are ongoing there. We think there are opportunities to take that a lot further, and as 5G matures in Australia, and you think about the mobility advantages that offers, especially to our renting audience, and there's an obvious overlap there that we're keen to explore. Insurance is a big one. There's a bunch of companies out there. We had our own insurance product about a year and a half ago, and it was strong, but we had trouble selling it through the portal business, because people that are looking for a house will consume products that make that phase easier, but they're less interested in probably things that are more while you're in the tenancy period. So certainly insurance is important to us, but you'll probably see that manifest back into rent pay before, or equally as it hits the portal. But yeah, there are other segments. I think the finance, the banking, the mortgage one, I think is huge. But once again, we have this philosophy of this single partner model. And we need to remember too, there's this, rent and rent pay are same parents, and there's a feedback loop. And as customers, find a property, move into rent pay, there's advantages we can build into rent pay that when a person goes to move again, they're in a better position. And, simple little things like when you're a rent pay customer and you're building a buffer, we'll be able to export your ledger, attach it to your resume. So when you're applying for a property, not only will the resume show you're a great tenant and make you stand out against your competition, but we'll show in there things like you've maintained an average buffer of 1 week's rent. They're all things that add value to the consumer, making their journey easier. So yeah, really, really excited. And as I said, partner discussions are ongoing, and we see partners as a key part of our business.
Okay, great. Let me just check if we got any questions from the audience. Now, right now, I'll maybe jump in with another one then. In terms of the portal business, I mean, do you guys see yourselves growing that even further, or how much more do you think you can capture of the total market, given how big it is already?
Yeah, so we have most of the listings on our site already. There's about 80,000 properties rented every month in Australia, and we have about 700,000 UVs. So what's interesting for us is that our traffic profile is quite different to the other portals. We have an engaged audience. So to give you a simple example, around 70% of the people that come to our website each month did not come to our website the previous month. That's reflective of the cycle of renting. Domain is 21%. So 80% of Domain customers are going to Domain all the time. And that's reflective of a big sales side, the property snacking, etc. So so we're very filtered on our audience. We had some previous Roy Morgan research that indicated over half of our customers don't go to other portals. But our job is to, we do a lot more than just show listings. Over 100,000 customers a month come to our site to find out information about renting. We've participated in state government rewrites of the Residential Tenancy Acts in Western Australia and Victoria. So we're building up our profile, and renters do not have a voice in this country. So we will be that voice for renters, and the products we offer, the experience we offer in finding a home, our plan is that will be the superior experience in this market. So look, we're not going to do a takeover attempt on REA tomorrow, but we're tiny. We're only 25 staff. We're passionate. Every day we're helping people on this journey, and that's what gets us out of bed. So yeah, we do expect our portal business to grow, but we think the bigger opportunity in the near term over the next couple of years is certainly in our payments business. But they're related. They feed back to each other. Part of the rent pay opportunity is actually providing new revenue lines to real estate agents, which will then encourage them on the portal side. So there's a lot of interrelated opportunities here.
Yeah, as you say, the interrelations, it just becomes a positive feedback loop as you scale up the rent pay business to something similar in size to the portal business, and then it's not a case of, I guess, 1 and 1 equaling 2. It's kind of 1 and 1 equaling 3. Would that be fair to say?
And very much so. And once we get to, we've set ourselves a target of 200,000 customers on rent pay in 2 years. Now that's a ludicrously ambitious target. We accept that, but we like ambitious targets. you know, and at that point we're talking, you know, $400 million business. So we, you know, we believe in what we're doing. We are creating a new segment. So that's, you know, that's not without its challenges. We don't have the pockets of some of the bigger guys, but that's fine. We are laser focused on our renting segment. It's a growing segment. There's more renters in Australia every year. The renters are becoming wealthier, smarter, more agile. They're looking for services. They're tech savvy. It's a great segment to be in. And the, you know, I live for the day where as a society, we lose this stigma around renting somehow being this secondary choice, when for many people under the age of 40, it's the absolute primary choice and the logical choice. Now, whether that's forever or just for a certain stage of your life, you know, we just need to lose that stigma. And that's what we're all about, promoting the renting lifestyle.
Okay, Greg, I think that brings us nicely up on time. We'll leave it there. And I just want to pass on my thanks to you and Jan for coming in last minute when our other presenter just couldn't make it this morning. So thank you very much for stepping into the breach. And yeah, we'll keep a close eye on the rent pay numbers and everything rent.com.au related over the next couple of quarters. It certainly seems like there's a lot happening under the hood.
Oh, and there's a ton of stuff ongoing. And look, if anybody wants to have a chat, our email address there, that's straight to Jan and I. We talk to shareholders daily, so we're pretty open, easy to get hold of.
Yeah, thanks, Greg, and indeed, thanks, Jan. And I will wrap up the meeting at this juncture. And I'd like to wish everybody a good rest of their Friday. And thanks for everyone who tuned in this morning, and indeed for anybody who tuned into our events earlier on in the week. And yeah, good luck in the cup to everyone next Tuesday.